Hans Vrensen, you are Head of Research and Strategy at AEW Europe. Thank you for joining us on BiTV.
Thanks for having me, Luca-chan.
Inflation and rising interest rates have been major concerns for European real estate investors in recent months. Having recently published a report entitled 2023 European Annual Outlook, Positioning for Disruption, what is now AEW's principal scenario regarding these issues?
Our principal scenario is really still our base case, which is for a return to more normal inflation rates. In fact, some of the recent news is already indicating that inflation is coming down from its peak. There is still some remaining uncertainty around it, which is why we also still have our downside scenario, which we continue to monitor. It's actually also some of the news items that we see with recent settlements of wage negotiations in different sectors across Europe. We are starting to see more activity from unions, for example, to push for higher wages. In some cases, employers are agreeing to that. That is still a concern that could lead to longer inflation that is at an elevated level. Certainly, central banks have taken actions, but so this uncertainty that we still see at the moment is still basically putting an equal probability on the base case and the downside scenario for inflation and bond yields in particular. And that is tying a lot into our outlook for the markets going forward.
Yeah. And speaking of which, obviously, I have to ask, how do you see these trends, these macroeconomic trends affect commercial real estate capital markets, maybe in terms both of investment volumes, but yields also?
Yeah, I mean, let's start with the yields. The yields are clearly expected to move up. Real estate is not operating in insulation, so we are not an island. There's many other asset classes that investors can invest in and do, in fact. So we need to be competitive in our returns that we offer, which means that if the risk-free rate goes up, then we would expect also an increase in the property yields. And property yields are moving up, partially also because the interest rates that banks are charging for borrowing money that's secured by commercial real estate has been going up. That's translated into both margins as well as the swap rates. So, that means that if we shift from the yields that are going up to the transaction volumes, this sort of turn in the cycle, this sort of turn in property yields, that is quite difficult to absorb. Also, if borrowing is more expensive, then leveraged buyers will find it difficult to get accretive contribution from real estate borrowing, because the level of borrowing money is perhaps higher than the initial yield on the property. And then, of course, it's not really economically feasible to use that. We are one of the most capital-intensive industries around. If you have an increased cost of borrowing money, then very clearly a lot of investors will be withdrawing from the market. And that's exactly what we see. So our forecast for volumes is for them to come down. We have had a very strong first half, and even the third quarter was still very strong in the volumes that we saw coming through. But the fourth quarter, I think we will see a much lower volume than traditionally is the case. I mean, fourth quarter is, of course, the most busy quarter typically in any year. But we do think that with this quite big changes, that we will see a less active fourth quarter, and therefore a reduction in the overall transaction volumes for the full year of 2022.
Okay, thank you. And you mentioned a turn of cycle. In the new cycle emerging, which sectors and geographies do you see as the most attractive in 2023?
Yeah, that's really tied to your earlier questions. In fact, obviously, that's a very clever way of staging it as well. I think in the end, because of the fact that, especially in the UK, bond yields have stayed elevated since the Brexit referendum, and also given the different economic trajectory in the UK versus Europe, we have seen the bond yields and property yields maintain a little bit of a higher level in the UK, which, given the widening that we are expected throughout, is leaving the UK in a relatively better position at the moment. So our top pick for Europe as far as country level is UK, followed closely by Benelux. As far as sectors, our favorite sectors, based mostly on the fact that we have still strong rental growth in these sectors, are actually logistics and residential, where we do see yield widening coming through, but that yield widening is more than offset by the rental growth. So those are some of our favorite sectors. Of course, we have many different views across the almost 200 market segments that we cover in the European landscape. For those of your audience that are interested, obviously, some of our research is also available online and goes into a lot more detail for the individual markets, because there are quite big differences between the markets at the moment.
Great. Well, thank you very much, Hans Vrensen, for this insight. It's always a pleasure to have you on BiTV. And thank you all for joining us, and see you soon on BiTV.